One of the most interesting technical charts I've ever seen in 40 years. We have a cup and handle formation on both gold and silver that goes back 10 years. It's one of the most bullish technical formations you can have because most times from the handle that we're going through now, it breaks to the upside versus the downside. So when I look at all the fundamental things and then I look at the technical, I have to say I'm really bullish.
Years and months ahead. So I'm incredibly bullish on gold. I have the majority of my portfolio invested in gold-related equities, and I'm patiently waiting for company in that boat that's pretty empty right now in terms of the gold bull boat right now. I mean, silver is a commodity that always does very, very well once the gold bull market gets running. You can look at the gold to silver ratio. I think once gold makes new all-time highs, which I'm quite confident it's going to make in the next 12 to 18 months, you're going to see silver do really, really well.
As observed on the daily chart, gold price confirmed a bull flag formation after closing Wednesday above the falling trendline resistance of $1,976. The 14-day Relative Strength Index, RSI indicator, is teasing the overbought territory, suggesting that there is enough room for the upside. From a short-term technical perspective, nothing seems to change for gold price, as it still remains a buy-the-dip trade. The immediate resistance is now seen at the July 20th high of $1,988. Gold buyers will then flex their muscles toward the 5-month highs of $1,997 en route, the $2,000 barrier. On the flip side, if gold price faces rejection at a higher level, the static support at $1,963 come into play on the correction. Further south, the $1,950 psychological level will be retested. During the interview, the question was asked by the interviewer that, how are you feeling about gold and also silver in terms of the equities? PeterGrandich, founder of PeterGrandich and Corporations, discusses we have one of the most interesting technical charts I've ever seen in 40 years. We have a cup and handle formation on both gold and silver that goes back 10 years. It's one of the most bullish technical formations you can have because most times from the handle that we're going through now, it breaks to the upside versus the downside. So when I look at all the fundamental things, and then I look at the technical, I have to say I'm really bullish. 2 quick thoughts. Before diving into interview, subscribe to our channel and give this video a big thumbs up. Thank you and enjoy.
I look at it a little bit different how I come to gold because what's left of my life and business is still with a planning group that does financial planning here for U.S. residents. And what I find is astonishing is that even after what happened in 2022, and suddenly people were walking around and seeing they were retired and they were down 30% and they were trying to figure out how they were going to pay. And they got a little rally in 2023, but now that's turned down again and they're getting worried. When I sit with those people, Jesse, most of their wealth is in some sort of financial asset. And I say to them this, listen, do you have home insurance? Yeah. Well, why do you have it? Well, in case something happens to my home. I say, you have car insurance? Yes. You have health insurance? What insurance do you have in case your financial assets don't work? And remember, people that own stocks used to say, well, my insurance was bonds. And we kind of discussed that that's not the best insurance anymore. They have almost no exposure to gold. Many of them zero. And then I tell them this, and I always get the same reaction, Jesse. It's really kind of funny still. I say, I want you to consider owning gold and pray to God it doesn't go up. And they look at me and go, why would you want me to buy something that's not going to go up? Because if it does, I can pretty well assure you that your financial assets went down. And some of them think and get considerate, then they get caught up in the don't worry, be happy philosophy that's prevalent in at least here in the financial service industry in the United States. But never has it been more an appropriate time to consider it. I think the other thing that we have to understand, I think the big changes for me anyway, is we have to understand there's 2 markets. There's the paper market, which was dominated until recently, basically between London and New York. That's an important change now. It's moving more and more to the Far East, and we're seeing less of, not gone, but less of the manipulation in the paper market. That's an important part of the equation. People in that part of the world have a much better understanding and appreciation of gold than they do. So I'm pretty confident, that we went through a normal correction. 2 quick thoughts, because I know you want me to answer about mining shares. The thing that's changed for PeterGrandich about gold is I always used to get in trouble with the silver bugs because I would always tell them I would want to own twice as much gold as I wanted to own silver. And that it was, in a sense, second class. Oh, well, I can't tell you that was as bad as some things you can say, but I do believe now they basically deserve equal attention. Silver's fundamentals have changed dramatically. If you're going to believe all the electrification and the solar and all that kind of stuff. So I'm pretty well evenly divided there. The one thing I'll just say about mining shares, and after suffering losses of 70, 80% in stocks, that if you came to me 6 or 12 months ago, I would have told you bottom, step up then. Never has there been evaluations. Now, I won't mention the company because Michael's a board member of it, but I just interviewed their president before we just did this. And he noted basically the company's being priced at about $5 an ounce for their known gold. That is beyond fire sale. That is beyond ridiculous. You have to have the courage to step up and buy anything which in the ground is being valued at $5, $8, $10. And it's widespread. It's not just limited to the one company that Michael's a board member of. And I'll just tell you, that's why getting past these next few weeks, getting through 2023, getting through where most retail people just throw in the towel and just say, I want to start the new year with a clear head. I think as bad as 2023 was, 2024 and beyond is going to be the best junior resource bull market we've ever seen. And we just have to try to survive for the next 2 to 3 months to get there.
Notable recent events triggering large spikes in the debt include the Afghanistan and Iraq wars, the 2008 Great Recession, and the COVID-19 pandemic. From FY 2019 to FY 2021, spending increased by about 50%, largely due to the COVID-19 pandemic. Tax cuts, stimulus programs, increased government spending, and decreased tax revenue caused by widespread unemployment generally account for sharp rises in the national debt. Over the past 100 years, the U.S. federal debt has increased from $405 billion in 1923 to $33.17 trillion in 2023. Now we listen to MichaelGentile's insightful comments about his thoughts here on gold and the gold mining space. He thinks there's opportunity at the moment, and his thoughts on silver as well.
The US, the gold price it's still up 5% year to date, last time I checked. So it's done a pretty good year. You can never tell it looking at financial commentary, looking at the stock market, that the gold's actually up year to date with the room it's had in the last couple of days. But I would say I'm incredibly bullish on the outlook for gold. And the reason is, regardless of what happens in the next 3 months, 6 months to 2 years, the US is sitting on $33.5 trillion of debt, as Peter just mentioned, right? They're running deficits of $1 to $3 trillion a year at infinity, basically. The only way to contain a deficit that large, the interest expense on the US debt is now going to be the single largest expense item above Social Security if you ran a 5 or 6% coupon on the debt. That's what the current rates are. So as the debt gets rolled over and refinanced the next 3 to 4 years, your largest expense as the government is going to be interest expense. That is simply not sustainable for any country, let alone the largest country, economic country in the world. So you've got a major interest rate problem, you've got a major deficit problem. The only way the US is going to contain that is by suppressing rates at some point in time. So gold has gone down because the interest rate has risen and inflation expectations have come down. So the real interest rate, which is the interest rate on your debt minus inflation expectations, has gone positive. It's gone to about 2.5% from negative last time gold was $2,000 an ounce. In the future, the only way you're going to float these deficits and balance your budgets if you suppress the rates below a level that inflation is running. So we need negative real rates going forward to fund the excesses in our system. And that's whether that's kicked off by a war that you got to fund, whether that's kicked off by the bond market revolting in your face, that's kicked off by multi-trillion-dollar deficits by future governments in the future. That's a guarantee to me in my mind. I don't know when that's going to happen, but you're going to have to see yield curve control like we had in Japan, like we had elsewhere, because we cannot afford the interest on our debt, and you can't pay off the debt if you're running deficits. So that's the mega trend for gold longer term. I think it's a big positive backdrop. When you take a step back and look at the stocks, Peter and I scratch our heads looking at the stock market. You would never guess that gold's trading at $19 an ounce, looking at the average small to mid-sized gold company trading in the market. They are beyond despair, despondent, apathy, no ability to raise money. Valuations are probably 30 to 40-year low, especially for the smaller companies. So when you have a strong gold price already with a tailwind for potential new high gold prices in the future, coupled with major depression / just giving up in the gold market in terms of equity investors, that to me is a fantastic setup to be a really strong sector. So once gold makes new all-time highs, you expect silver to be up 3-4% on a day where gold's up 1%. Up until now, you've been seeing the smart money, the central banks, those that see the long-term institutions see the writing on the wall are accumulating gold, but we haven't kicked in the retail crowd yet. We haven't kicked in the speculative crowd yet. Those are the guys and girls typically take silver higher. So again, if you see gold make a new high, I think silver will be really strong performer on the back of that in the next 12 to 18 months after that.
Gold held nearly steady on Tuesday after hitting a 5-month high last week, while traders kept one eye on U.S. economic data and another on tensions in the Middle East. Spot gold ticked 0.1% higher at $1,975.39 per ounce, after falling as much as 1% earlier in the session. U.S. gold futures settled 0.1% lower at $1,986.1. Spot silver was flat at $22.97 an ounce. Platinum dipped 1.2% to $885.88, while palladium gained 0.8% to $1,127.04. We saw some profit-taking earlier in the session, and then traders came to buy the dip. $2,000 is still on the cards for the near term, or even a new record high if there is an escalation in the Middle East crisis, said Jim Wyckoff, senior analyst at Kitco Metals. Gold prices have climbed about 9% in the past 2 weeks, hitting a 5-month high of $1,997.09 on October 20th, a rally mainly fueled by safe haven inflows on concern Israel's war with Islamist group Hamas will spread. But gold's inability to rally this week is a signal that safe haven demand has started to wane as markets learn to live with tensions in the Middle East. Marios Hadjikyriakos, senior investment analyst at Forex broker XM, wrote in a note, "Direction of gold for the foreseeable future will be linked to the direction of interest rates. If the economy weakens and there's a view in the market that we are entering a recession, then interest rates will likely decline and the price of gold will likely go up," said Chris Mancini, associate portfolio manager of the Gabelli Gold Fund. What do you think about PeterGrandich and MichaelGentile's interview? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel and turn on notifications to stay informed about our latest videos. See you in the next video.